this is a time when we take stock on the year that we saw, and it was a roller coaster ride for oil prices. Did that mean that traders made money in this kind of environment, or was this a tough environment for a lot of traders like yourself to become profitable in?
So I think generally volatility does create an environment where traders can make a lot of money. And I think certainly some traders did this year. However, I think there was a misconception in the market by many analysts and traders at the start of the year when we had the reflation trade still with a lot of fire behind it. The Fed had not become as aggressive as they are now. And then we had the Russian invasion of Ukraine. And that was just a huge sentiment shift. And kind of everyone got on one side of the boat and leaned really hard into that long. And it seemed like there was not many voices out there spewing kind of that bearish side of the trade. So I think a lot of people did get sucked in a little bit to that trade. I call it the Jedi mind trick of you must be long crude at this time. And that kind of did backfire. It took some people out. We saw some forced liquidations occur about 2 or 3 weeks ago. People just couldn't continue to make money in the market. They'd gotten chopped up. So I do think this environment, although volatility generally is great for traders, this particular year has been a little bit tougher on the trading community and caused some pretty significant losses.
Now, Rebecca, can you tell us a little bit from your perspective about what's happening with the crude curve, the futures curve right now, right? It almost feels as though it's been a transitional stage in 2022. We've seen areas where future oil prices are higher than lower than current ones. And we've seen times when we've seen future oil prices become less than current spot or current prices right now. How does that contango backwardation kind of shifting affect how traders view what's going to happen for oil prices in 2023?
You bring up a great point, Dom, because the crude curve is the holy grail for traders. When you are in contango, it is generally a sign that demand in the present right now is weaker than what you're expecting in the future. It incentivizes to a certain extent you to store crude as opposed to selling it now on the open market because the demand isn't there. We have undergone over the last month a huge shift from a severely backwardated curve, showing us and spurring people who were very bullish on the commodity on, like, hey, demand is strong, don't fall for this move lower. But as the curve has shifted into contango, it's really a reflection that that spot demand may not have been as strong as most people were anticipating. And it's really kind of shaken the conviction of the bulls out there. And I think that was a large part of why we saw some of those liquidations and saw people really abandon ship on those longs. I do think when I look out further in the curve, and how compressed it is, and given the catalysts we do have, and when those catalysts aren't just Russia's supply coming offline, it also pertains to the SPR no longer being a buffer. We have released 280 million barrels of SPR so far this year. That's a huge number. So when that rolls off and we switch into needing to refill the SPR, we're going to see a lot more support under the commodity. The second thing I think really supports the commodity and should be supporting the back end of that curve is OPEC. OPEC has been very vocal that they will continue to support crude. They want stable markets. They're not going to let it fall into free fall as they've done in the past. And the reason they're able to do that without as much consequence is U.S. production is growing at a slower rate than it has in the past, and they're not as afraid of losing that market share.